What's going on, guys, and welcome back to another video. So Facebook just reported their earnings, and I thought that I would save you the job of having to read through the earnings report, and I'll quickly make a video to summarize the key points, right? So we can see that in the after hours, Facebook stock is up just over or just under 2%, right? So it hasn't moved an awful lot. I was sort of watching where it went in the after hours, and we can see here it did rise by about 5%, but then by the time the sort of earnings call finished, it dropped down again, so now we're just below 2% gain in the after hours. But let's take a look at what has actually happened in the quarter. So we can see here the headline quote from Mr. Mark Zuckerberg, the CEO, and he says that we made good progress this quarter and our community continues to grow. I'm excited about our roadmap, especially around creators, commerce, and helping to build the Metaverse. Now that's an important point which we'll come on to in a moment, but first let's look at their financial highlights. So we can see here that they achieved revenues of $29 billion, and that is a 35% increase on the $21.5 billion that they earned in 2020. So absolutely fantastic growth. However, that is actually a miss on their estimates, right? So when we see what was estimated, analysts were expecting just shy of $29.5 billion. So there's a slight miss on revenue there, right? If we go all the way down to diluted earnings per share, they earned $3.22, and that is compared with $2.71 the year earlier. And that was actually slightly better than what was expected, right? So we can see here earnings per share of $3.22 versus $3.17, which analysts were expecting. So that's quite good, right? However, one thing to note here, right? So revenues increased by 35%, diluted earnings per share only increased by 19%. So what does that mean, right? It means that our costs have increased proportionately more than what our revenue has increased, which is not a good sign, right? Effectively, margin contraction means decreased profitability, which is not a good sign. So it's important to understand what is going on here, and is that a signal going forward for decreased profitability? So when we actually run on a line-by-line basis, we can see that operating margin did indeed decrease. So in 2021 of the third quarter, it was 36%, and that is compared with 37% the year earlier. So not a significant change. We'll get into the details of what was actually driving that specific change later on, but for the most part, it's relatively flat. So it's not really the contributor for the significant difference between the 19% growth in earnings compared with the 35% growth in revenue. What we do see, however, is the provision for income taxes. So that has increased significantly, and that's actually a 378% increase. So in Q3 2021, it was $1.4 billion, and in Q3 2020, it was just shy of $300 million. So that's a significant change, and we can see that the effective tax rate in Q3 2021 was 13%, which is more or less in line with what we would really expect, compared with only 4% in Q3 2020. So when we actually understand what is driving that, we can see that there is a note below here, and it reads, our third quarter 2020 effective tax rate was 4%, which reflects a one-time income tax benefit of $913 million related to the effects of a tax election to capitalize and amortize certain research and development expenses for US income tax purposes. Excluding this tax benefit, our effective tax rate would have been 11 percentage points higher, and our diluted earnings per share would have been 31 cents lower. In other words, if you take away that tax credit that they had, the sort of earnings per share has actually increased largely in line with our revenues. So there isn't a significant amount of margin contraction there when you exclude for the one-off tax credit. So absolutely no concerns there. And then moving on to some of the other key metrics. Now, one of the most important metrics that we like to look at is the family daily active people, right? So this is the number of people every day that are logging into either Facebook, WhatsApp, Instagram, or Messenger. And this blows me away every single time, right? So daily active people was 2.81 billion on average for September 2021, which is an increase of 11% year over year. Absolutely staggering growth, right? So considering the fact that in Q3 2020, a lot of people were stuck at home, working from home in a lockdown, and therefore using these apps more and more, we're still seeing continued growth. And that 2.81 billion is actually slightly higher than what analysts were expecting. Analysts were expecting 2.76 billion, so clearly that's good to see as well. Regardless, right, it's a huge number of people that are logging into their apps every single day, which allows them to generate these amazing financial results. And then moving on to another key highlight is share repurchases. So we can see here that we repurchased $14.37 billion of our Class A common stock in the third quarter and had $7.97 billion remaining on our share repurchase authorization as of September 30, 2021. We also announced today a $50 billion increase in our share repurchase authorization. Now, in my opinion, this is a great move from management. So management realize or believe that Facebook stock is vastly undervalued, and therefore they are using the opportunity to repurchase shares and effectively distribute capital back to shareholders, right? So Facebook don't pay a dividend, but they are repurchasing shares, which for the vast majority of people is a more tax efficient way of distributing capital to shareholders. So that is absolutely fantastic, right? And we can see that they had cash and cash equivalents at the end of the quarter of $58 billion. So they've got a huge amount of cash, they're reinvesting in the business, and they are also repurchasing shares to distribute some of that capital to shareholders. And then we come on to the comments made by the Chief Financial Officer. Now for me, this is the most exciting and the most important part of the earnings report. And we can see here that starting with our results for the fourth quarter of 2021, we plan to break out Facebook Reality Labs, or FRL, as a separate reporting segment. As we have discussed, we are dedicating significant resources towards our augmented and virtual reality products and services, which are an important part of our work to develop the next generation of online social experiences. The new segment disclosures will provide additional information on the performance of FRL and the investments we are making. So as it stands right now, we can't actually see how much is invested directly into the Facebook Reality Labs. We can't see the revenues that they're generating. We can't see that the profits, if any, that they're generating. We can't see that the growth that they are generating. And therefore, it's really hard to forecast going forward what the prospects are for the business. However, what they're going to do is split these two segments out, right? So we've got effectively the Facebook apps being Facebook, WhatsApp, Instagram, and Messenger. They will be one reporting unit, and then we will have the Facebook Reality Labs as another reporting unit. And this is fantastic news for any investor that is trying to project the results or the forecast for the business going forward. Now, we do know that Facebook are investing massively into this segment, right? So we can see here that we expect our investment in Facebook Reality Labs to reduce our overall operating profit in 2021 by approximately $10 billion. We are committed to bringing this long-term vision to life, and we expect to increase our investments for the next several years. So generally speaking, if a company was to release news to say that our profits, we're expecting those to be 10 billion, or our operating profits are going to be $10 billion less a year from now, every investor is going to run a mile, right? However, for Facebook, it's slightly different, right? We're going to see exactly what they're investing in and what that is going to mean for the business going forward. And the fact that they are investing so heavily in Facebook Reality Labs goes to show management's intentions and what they think that this can potentially be in the future. Management then also provided some fourth quarter guidance as well. So they're expecting 2021 fourth quarter total revenue to be in the range of $31.5 to $34 billion. Now, this is a slight decrease on what was expected beforehand, where I think analysts were expecting fourth quarter revenues to be around $34.5 billion. So it isn't a huge decrease, but there is a decrease there nonetheless, right? And when we read into it further, our outlook reflects the significant uncertainty we face in the fourth quarter in light of continued headwinds from Apple's iOS 14 changes and macroeconomic and COVID-related factors. In my opinion, the most significant headwind is the changes made to iOS 14, which means that Facebook aren't able to track and effectively target their ads as well as they previously could, and therefore generating less revenues as a result of that. We saw the impact that that had on Snapchat stock, where their stock actually fell by 25%. So Facebook have actually been pretty robust despite these changes, and I actually think that that is quite a positive as well. And then just a final point on the investment that Facebook are making in the business. So we can see here that we expect 2021 capital expenditures to be approximately $19 billion, and that is pretty much unchanged from the prior guidance. However, right, for 2022, we expect capital expenditures to be in the range of $29 to $34 billion, driven by our investments in data centers, servers, network infrastructure, and office facilities, right? So over a 50% increase on their capital expenditures is absolutely huge. And Facebook has a fantastic track record of a great return on their incremental invested capital, and therefore we're expecting a significant uptick in their results going forward as well, which should then be reflected in the share price. Now, coming back to the separation of the Facebook Reality Labs reporting segment and the Family of Apps reporting segment, we can see that news was released a few days ago, which actually said that Facebook are planning to change their name, right? And this is all to do with the fact that they want to be known as not just a social media company, but also effectively what Mark Zuckerberg is describing as a metaverse. So we can see here the word metaverse is a term borrowed from science fiction and refers to a future version of the internet that people access using virtual reality and augmented reality technology rather than laptops and phones. Mark Zuckerberg first publicly announced in July that he wants Facebook to eventually become a metaverse company. Mark Zuckerberg is somebody with a huge amount of vision and a huge amount of drive, and it's great to see that he's actually pushing Facebook away from purely just social media, which we all know has a huge amount of negative connotations attached to it, which, to be honest, is why I believe that the sort of valuation of Facebook is quite depressed relative to its peers. And clearly it's moving into a different business structure altogether. So once again, it comes back to the point that I was making, and I know that I keep banging this drum, right? But I think it is huge, and I'm surprised that the markets haven't reacted better to it, to be honest, that the splitting of the two reporting segments is going to make this change from Facebook being purely a social media company to something so much more. And this change of the name is actually very similar to the change that Alphabet or Google made back in 2015. So pre-2015, Alphabet was known as Google, right? And then following that, they are now known as Alphabet. And that's because they didn't want to be known as just Google, because they have so much more to their business than Google alone. If in a few years' time that Facebook is actually able to transition away from purely a social media company into this metaverse, whatever that will look like, it's quite possible that the business as a whole will actually attract higher multiples. So what I was saying earlier, that I think that Facebook's multiples, right, are actually contracted or depressed because of the negative connotations that are associated with Facebook. I actually know a number of people that actually flat out refuse to invest in Facebook just because they don't agree with it, right? And that's fair enough. Everybody has their stance on what they want to invest in. But I do wonder whether they can move away from these negative connotations, which will then push up the share price due to higher multiples what investors are actually willing to pay. It's kind of right, although not on such an extreme level, in some of the old dirty oil companies that are trying to transition into green energy. If they can make that transition successfully, it's quite likely that a lot of the investors are actually going to be more willing to invest in that company, therefore pushing the multiples up and therefore pushing the share price up. Now, the final thing that I did say that I would touch on is what is causing the contraction in their operating margins, right? So what is causing the increase in their operating costs? So we can see here that in Q3 2020, their operating margins were 37%, compared with 36% in Q3 2021. So that is obviously isn't a huge decrease, right? It's a decline of just 1%. But when you compare it to the quarter previously, we've gone from 43%, 43% and 46% right the way down to 36%. So clearly that is a significant decline. Now, generally speaking, you shouldn't compare one quarter to another. You should actually compare the quarter to the same quarter a year ago, right? Because of seasonality in a business. But that usually applies primarily to revenues, right? So for example, a company might be willing to spend more revenues on advertising in summer than it would in the winter months, right? Just due to the particular seasonalities of industries. However, for costs, the same doesn't really apply. So the fact that we've gone from operating margins of 43% down to 36% is quite concerning. And when we actually look at the breakup of that, right, we can see here that general and administrative costs is the main driver. So that's gone from 7% right the way up to 10%. And then we've seen a sort of a 1% increase in each of the other sorts of sectors or sections, being marketing and sales, research and development, and then cost of revenue. So what I've done is I've tried to find out what has caused the relatively significant increase in their general and administrative costs to try and find out whether this could be a trend for decreased margins for the business going forward, in which case we would have to update our valuation for the business. So I wasn't quite able to catch the earnings call as it happened. So what I did is I went and had a look at the earnings transcript to see if management gave any indication as to what was causing that increase. So we can see here that management said that general and admin expenses increased 65%, driven primarily by higher legal related costs and employee related costs. Now, legal related costs, fair enough, there could have been some one-off expenses within there. That is fine. It seems like a one-off expense, and therefore it's unlikely that that expense is going to continue going forward. So that is fine. Employee related costs, you're not quite sure whether that's going to be something going forward or not. It could be something like redundancies. in which case it is a one-off cost and you wouldn't forecast that in your models going forward. Or it could just be general sorts of salaries and wages, in which case then you do need to factor that in. So we'll have to look out for the next couple of quarters to see whether general and admin costs actually continue to be elevated, or whether we see a decline going forward. My expectation is that a lot of those costs are actually going to be legal related costs, which are one-off in nature and therefore shouldn't be included in our forecast going forward. Anyway guys, that pretty much touches on all of the important parts from the earnings report. I hope you enjoyed the video and you found it useful. Let me know if you're invested in Facebook and why or why not. And until next time guys, thank you.